Hello, welcome to the presentation on LKAS 10 events after the reporting period. Today we'll delve into the guidelines the standard sets for accounting for events that occur after the end of the reporting period of financial statements. Understanding how to handle these events is crucial for ensuring the accuracy and transparency of financial reporting. So let's move on to the content of this presentation. So in this presentation, we'll be discussing objective and scope, definitions of the terms used in the standard, recognition and measurement criteria, how to disclose the dividends after the reporting period, and going concern disclosures and other disclosures as well. Let's move on to our next slide. Now we see the objective and scope of the standard. The primary objective of LKAS 10 is to ensure consistent and informative financial reporting by establishing clear guidelines on how to handle events that occur after the end of the reporting period. The standard outlines specific criteria for adjusting financial statements, disclosing information, and considering the going concern assumptions. Accordingly, when events occurring after the reporting period provide evidence of conditions that existed at the end of the period, adjustments need to be made to the financial statements. Also, companies are required to disclose the date their financial statements were authorized for issue and any relevant events that happen after the reporting period, even if they don't impact the financial statements directly. If the events after the reporting period indicate the company might not be able to continue operating as a going concern, the financial statements should not be prepared under this assumption. So, what is the scope of this standard? The scope of LKAS 10 is broad and encompasses the entire accounting and disclosure process for events that occur after the reporting period but before the financial statements are officially issued. So this includes identifying and assessing the nature and impact of the events after the reporting period, determining whether adjustments to financial statements are necessary based on the event's nature and its relation to conditions existing at the end of the reporting period, and disclosing relevant information about these events, even if they don't directly affect the financial statements, to provide users with a more complete picture of the company's financial health. So let's move on to our next slide now. Okay, now we'll see definitions for the terms that is used under LKAS 10. So LKAS 10 defines terms to ensure a clear understanding and consistent application of the standard. These definitions are crucial for differentiating between events after the reporting period, adjusting events, and non-adjusting events. So first we'll see what is meant by events after the reporting period. So events after the reporting period encompass all events, both favorable and unfavorable, that occur after the accounting period ends but before the financial statements are authorized for release. These events can be divided into two, adjusting events and non-adjusting events. So we'll see what is adjusting events. These are events that provide additional evidence about the conditions that existed at the end of the reporting period. So they may necessitate adjustments to the financial statements to reflect a more accurate portrayal of the company's financial position. So what is meant by non-adjusting events? These are events that reflect conditions that arose after the reporting period's end and don't directly impact the financial statements. However, entities are still required to disclose them if they are material. What is meant by authorization for issue? Authorization for issue is the formal process of approving the financial statements by the relevant authorities or individuals within the company, signifying their readiness for official release. So this issue process varies depending on management structure of the company or statutory requirement, on the procedure for preparing and finalizing financial statements. Okay, now we are going to discuss the recognition and measurement requirement for the events after reporting period. First, we see the requirement for adjusting events after the reporting period. LKAS 10 emphasizes that not all events after the reporting period require adjustments. Only adjusting events necessitate changes to the financial statements. So these adjustments ensure the statements accurately reflect the company's financial position and performance at the end of the reporting period, even though new information has come to light. So here are some examples of situations that would consider adjusting events. A court case settled in February confirms a legal obligation existed for the company at the end of December, that is previous reporting period. So this would require adjusting the provisions relating to the case. So second example is a customer went bankrupt in February, indicating they were likely credit impaired at the end of December. So this might necessitate adjusting the impairment loss for receivables from that customer. So another example is the final cost of a machine purchased in December is determined in February. So this cost needs to be reflected in the December financial statements. I have mentioned another example. Let's assume a company has a profit sharing plan based on annual profit. If the final profit figure is determined in February, the profit sharing amount needs to be recognized in the December financial statements. So last example is if the company discovers an error in its inventory valuation after the statements are finalized, they need to be corrected the error in the financial statement for the period. So here is how we recognize and measure the events after adjusting events after the reporting period. Now we'll see how to recognize and measure the non-adjusting events after the reporting period. So LKAS 10 differentiates between events that impact the financial statements and those that don't. So non-adjusting events like post-reporting period decline in investment value don't necessitate adjustments to the financial statement. This is because the decline likely reflect recent market changes and not the inherent value of the investments at the reporting period's end. So here I have given the comparison and examples for adjusting and non-adjusting events. Let's move on to our next slide. Okay, now we'll see how to recognize and measure the dividends declared after the reporting period. So this standard addresses the treatment of dividends declared after the reporting period. So if a company declares dividend after the reporting period but before the financial statements are authorized for issue, these dividends are not recognized as a liability at the end of the reporting period because the company has no legal obligation to pay them at that time. However, these dividends are still disclosed in the notes accompanying the financial statements to ensure the transparency of the financial statements for the users. As you know, the going concern assumption is a critical foundation for financial reporting. It allows us to value assets and liabilities based on the assumption that the entity will continue operating and meets its obligation. So, however, it's important to recognize that situations may arise that challenge this assumption. So, what will happen when the going concern assumption is not met? There are two primary situations where the going concern assumption would no longer be appropriate. The first scenario involves a deliberate decision by the management to wind down the entity's operation due to factors like bankruptcy, financial difficulties, or a change in the entity's business strategy. The second scenario occurs when unforeseen circumstances leave the entity with no viable alternative but to cease trading, such as natural disasters, significant legal issues, or loss of a key customer base. Okay, what is the impact of not using the going concern assumption? If management determines that the going concern assumption is no longer valid, significant changes have to be done. The financial statements can no longer be prepared on the assumption of continued operations. So this requires a fundamental shift in the accounting approach, potentially impacting the valuation of assets and liabilities and the recognition of certain income and expenses as well. So what are the disclosure requirements under LKAS 1 related to the going concern assumption? So LKAS 1 mandates disclosures in specific situations. So the first scenario involves cases where the going concern assumption is explicitly abandoned. Extensive explanations regarding the rational and potential financial statement impacts are required. The second scenario involves situations where significant uncertainties exist, even if the entity continues operating for the time being. So disclosing these uncertainties allow users to understand the potential risk to the entity's future viability. Okay, let's see the disclosure requirements under LKAS 10. So this standard mandates the disclosure of the authorization date and the authorizing body. This informs users that events after this date are not reflected in the financial statements. So additionally, disclosing the power to amend the statements after issuance ensures transparency of the financial statements as well. Updating disclosure about conditions at the end of the reporting period. So even though the financial statements are finalized, new information might shed light on the conditions at the end of the reporting period. So LKAS 10 requires updating disclosures in such situations, even if the financial statements themselves remain unchanged. So this ensures users have access to the most recent information. What are the disclosure requirements for non-existing events after the reporting period? Events occurring after the reporting period but before authorizations are generally non-existing events and don't directly impact the financial statements. However, if these events are material, they can influence users' decisions. Therefore, disclosing the nature and estimated financial impact, if possible, of such events is crucial for informed decision making. So here provides non-exhaustive list of examples of material non-existing events that require disclosure. But by understanding these examples, entities can ensure they are meeting the disclosure requirements of LKAS 10 and providing users with valuable information to make informed decisions. So here are the examples. So first example is major business combination or major subsidiary disposal after the reporting period, announcing an operation discontinuation, major asset purchases, classification of assets as held for sale, disposal of asset, or expropriation of major assets by government, destruction of a major production plant by fire after the reporting period, announcing or commencing a major restructuring, material ordinary share transactions except capitalization, bonus issues, split, abnormally large changes in asset prices or forex rates, significant changes in tax rates or law after reporting period, entering into significant commitments or contingent liabilities, commencing major litigations arising from post-reporting period events. So with that, we have now completed the study of LKAS 10 events after the reporting period. So I hope you gain considerable knowledge on this standard. So if you have any comments or any questions, please comment them in the comment section. So we'll see you with my next video. Thank you for watching this video.